In the heart of the financial world, where fortunes rise and fall with every tick of the clock, one concept stands as a powerful enigma: the stock dividend. Today, we're about to unravel the mysteries behind stock dividends. What exactly are they? How do they operate? And why should you, as an investor, care? Prepare for a journey that will change how you perceive the finance world. A stock dividend isn't just a financial term, it's a force that can reshape companies' destiny and shareholders' wealth. But before we delve into the details, let's start with the basics. What exactly is a stock dividend and how does it function? Imagine you're holding a single piece of a delicious pie. Now picture that pie being sliced into smaller, equal pieces, and you end up with more slices, but each is smaller than the original. That's essentially how stock dividends work in the world of investing. Stock dividends are when a company rewards its shareholders by issuing additional shares of the company's stock. This means that if you're a shareholder, you'll receive more shares than those you already own. The company divides its pie into smaller slices and hands them out to existing investors. But how do stock dividends differ from regular cash dividends? That's a critical question we'll answer shortly. And to make things clear, we'll illustrate the concept with a real-life example. So, whether you're a seasoned investor looking to deepen your knowledge or a beginner wanting to understand the world of finance better, this video is your gateway to unlocking the secrets of stock dividends. So, let's get started. Picture this. If a company decides to issue a stock dividend of, say, 5%, it means that for every share you own, you'll receive 0.05 more shares. So if you're holding 100 shares, you'd get an additional 5 shares. Pretty straightforward, right? So what exactly is a stock dividend? It's also known as a scrip dividend, a unique way for companies to reward their investors. Well, in simple terms, it's a payment to shareholders, but here's the twist. Instead of receiving cash, you get additional shares in the company you've invested in. But how does this work, and what are the key components? When a company issues a stock dividend, it typically does so in percentages. For example, if they announce a 5% stock dividend, you'll receive 5% more shares for every share you own. So, if you hold 100 shares of that company's stock, you'll receive 5 additional shares. It's like the company is saying, "Thanks for being our shareholder. Here's a little extra ownership." Here's where it gets interesting for investors: the tax advantage. Stock dividends come with a special perk. They're not taxed until you decide to sell the additional shares. That means you can enjoy the rewards without worrying about an immediate tax hit. But hold on, there's one more thing to consider: the holding period. Sometimes, when you receive a stock dividend, you might be unable to sell those newly acquired shares for a certain period. This period usually begins the day after receiving the stock dividend. Now let's address something crucial: stock dividend dilution. When a company issues stock dividends, it dilutes the value of its existing shares. In simple terms, adding more shares without a corresponding increase in capital can reduce the value of all the company's shares. For instance, imagine a public company approving a 5% stock dividend. That means existing investors can get 1 additional share for every 20 they own. If the shares were initially valued at $2.50 each and you owned 20 shares, you'd have $45 worth of shares. However, when you receive that additional share, you'd own 21 shares, and their value would be $45. This means each share is now worth $2.14, and that's how a stock dividend can dilute the value of your shares, somewhat similar to a stock split. Let's talk about the advantages of stock dividends. One significant benefit for investors is tax deferral. When you receive stock dividends, you don't owe taxes until you decide to sell those additional shares. This can be a real money saver, especially for long-term investors. Another advantage is that issuing stock dividends often lowers the stock price, at least in the short term. But why is that a good thing? Well, a lower priced stock tends to attract more buyers. This means that as a current shareholder, you might not see immediate gains, but your investment could become more attractive to other investors down the road. Additionally, stock dividends offer flexibility. Investors can choose to sell the additional shares, immediately pocket the cash, and still retain the same number of shares they had before. This flexibility can be a valuable strategy for those seeking short-term gains or needing extra liquidity. Now that we've covered the advantages, let's discuss the disadvantages. The most apparent drawback is that there's often little immediate cash reward for receiving stock dividends. If you were hoping for a cash payout, stock dividends may not meet your expectations. Furthermore, as mentioned earlier, the lower stock price resulting from a stock dividend can be considered a disadvantage. It can make your investment riskier in the short term, especially if market conditions are uncertain. It's essential to consider your risk tolerance before opting for stock dividends. Lastly, from a company's perspective, issuing stock dividends is challenging. A public company is not required to issue dividends, but suddenly stopping or reducing dividend payments can negatively affect its reputation and shareholder confidence, so it's a balancing act for companies. Let's shift our focus to the pros and cons of stock dividends for investors. One significant advantage is that a company's cash balance remains unchanged when issuing stock dividends. This is a big plus because it allows the company to reward shareholders without depleting its cash reserves. Another pro is that a decrease in share price, often resulting from stock dividends, can attract new investors. Lower priced shares may appeal to individuals who previously found the stock too expensive. This can potentially broaden the company's shareholder base and increase liquidity. Lastly, it's important for companies to note that stock dividends don't trigger immediate tax obligations. Taxes are only owed by investors when they decide to sell the additional shares received as dividends. This can be advantageous for companies and their shareholders alike. Now let's dive into the disadvantages or cons for companies when they opt for stock dividends. From an investor's perspective, one major pro is tax deferral. Investors do not owe taxes on stock dividends until they decide to sell the additional shares they receive. This can help them save on taxes, especially for long-term investments. However, the main con for investors is also share price dilution. When a company issues stock dividends, it increases the total number of shares outstanding, which can dilute the value of each existing share. This can impact the overall value of the investor's portfolio. Lastly, it's important to note that share dividends may be less attractive to some investors than cash dividends. Some investors prefer the immediate cash flow from cash dividends, while others may focus more on long-term capital appreciation. Understanding journal entries for small and large stock dividends. Understanding these entries is crucial for companies and investors, so stick around to learn all about it. Let's start with small stock dividends. A stock dividend is considered small if the shares issued are less than 25% of the total value of shares outstanding before the dividend. When a small stock dividend is declared, a journal entry is necessary. This entry transfers the value of the issued stock from the retained earnings account to the paid-in capital account. Let's break it down with an example. Imagine Company X, which has 500,000 shares of common stock with a par value of $1 per share and a market price of $5 per share, declares a 10% stock dividend. In this case, the market price of $5 per share assigns the value to the dividend, which amounts to $250,000, 500,000 times 10% times $5. The common stock dividend distributable is $50,000 or 500,000 times 10% times $1, since the common stock has a par value of $1 per share. Now, let's move on to large stock dividends. These occur when the new shares issued are more than 25% of the value of the total shares outstanding before the dividend. Regarding a large stock dividend, the journal entry is slightly different. It transfers the par value of the issued shares from retained earnings to paid-in capital. Here's an example. Suppose Company X declares a 30% stock dividend instead of 10%. In this case, the value assigned to the dividend would be the par value of $1 per share, as it's considered a large stock dividend. The journal entry would then be $150,000, $500,000 times 30% times $1, using the par value instead of the market price. To wrap it up, understanding the journal entries is essential when it comes to stock dividends. Small stock dividends are valued based on market price, while large stock dividends use the par value. These journal entries ensure that the company's accounting accurately reflects the distribution of dividends to shareholders. Now, you might be wondering why companies issue stock dividends in the first place. Whether in cash or stock, dividends are essentially the shareholders' share of the company's profits. They are a way to reward shareholders for their loyalty and holding on to the company's stock. Companies may issue stock dividends instead of cash to retain more cash reserves for other purposes such as reinvestment or financial stability. Let's clarify the difference between a stock dividend and a cash dividend. A stock dividend is paid out in the form of additional company shares. Importantly, it's not taxable until you decide to sell those shares. On the other hand, a cash dividend is paid out as cash and is taxable in the year it's received. You'll typically receive a 1099 DIV form from the company at the end of the year for tax purposes. Let's address a common question. Is a stock dividend a good or bad thing? In general, dividends are always positive for shareholders, whether in the form of shares or cash. However, whether it's good or bad depends on your financial goals. If you're investing for income and prefer a regular cash flow, you might lean towards cash dividends. Speaking of dividends, what's considered a good dividend yield? A good dividend yield typically falls from 2% to 5% annually, whether paid in cash or shares. When researching stocks online, check the dividend yield line to determine what a company pays out to its shareholders. That's a wrap for today's episode on stock dividends, where we delved into what they are and how they work, complete with a clear example. We hope you found this video informative and that it has given you a better understanding of this important aspect of investing. If you enjoyed this video and found it helpful, please don't forget to hit that like button and share it with others who might benefit from this knowledge. Subscribe to Stock Market Catalyst for more in-depth financial insights, investment tips, and educational content. Knowledge is the key to making sound investment decisions, so keep learning, stay informed, and make your investments work for you. Thanks for tuning in. Check out more videos about trading versus investing and mastering the basics of investing stocks. These videos will guide you through the inner workings of the financial world, making it easy to understand. Until next time, see you in the next video.